Hey, Mark. Welcome to the A Game podcast hosted by Navatar. Good to see you here. So, for those who don't know, Mark Allen here is a managing director at New Republic Partners. And Mark is one of the guys, most knowledgeable guys I know who spent his lifetime investing in alternative asset funds, different asset classes. Maybe you can talk about yourself, Mark.
That's great, Alok. Thanks so much for having me. Really looking forward to this. Yeah, my background is I've always worked in the sort of direct lines of the alternative investing business over really 25 years at a few different hedge funds. Last hedge fund I was with was called Scopia Capital, which we really built out private equity, credit, hedge funds across different strategies and I left that world in the first quarter of 2022 and then migrated into the family office space over the last 2 years. And so it really sort of bringing that direct experience in the alternative side of things, really in the investing, trading, risk management has really sort of helped me in the family office space as we really focus on the alternative side of things.
Great, because then you have a viewpoint on this. The topic everyone's talking about right now is we just had the election. We have a new regime coming in, and so we're excited at Navatar because as you know, we're the more deal making activity happening, and our platform powers all the intelligence for deal making. So that's exciting for us. But where do you see, from an investment standpoint, for investing into these funds, how does the landscape change? I would assume that people now have to, think about their portfolio in a different way.
Yeah, look, it's a very interesting time. I think it's always a little bit tricky when you have kind of a new regime, new president, new folks in the House and the Senate take over, and this was obviously a huge election on many fronts. And yeah, I think there is a bit of a paradigm shift. Time will tell as far as how it all plays out, but. I think from just sort of a top level, the way we've sort of thought about things, the way I think about things is, there's clearly going to be some changes in, China-U.S. relations, a bit more kind of onshoring, if you will, and less sort of globalization, which in a lot of ways is inflationary. And you've definitely, seen those inflationary forces rear its ugly head kind of post the pandemic, and obviously came down a bit going into the election, but I think it's something that investors really need to think about. What does that mean in the public markets? The Mag Seven have really sort of dominated the marketplace, and there's a somewhat of a probability that things could kind of either broaden out, or there could be capital flow shifts as you look out. Potentially into sort of energy resources, those areas. So I think some managers that kind of focus on those parts of the economy and those industries actually could see some interest. And there's definitely been very little capital going into kind of classic fossil fuels, carbon, energy, et cetera. And I think on the healthcare side of things, Trump's already sort of making a lot of decisions on who's going to be in certain positions. But healthcare could go through some changes over the next kind of 2 to 3 to 4 years. And I think the monetary side of things is another thing. I mean, there's been the Fed is independent, but how much kind of cage rattling is there going to be between the new administration and Fed policy? So there is argument to be made too that if inflationary forces kind of come back and really sort of stay stubbornly high, that the Fed is not going to be able to take interest rates down too much. And so what does that do for various managers across private equity, credit, hedge fund managers? Because you really have some competition with the sort of risk-free rate of return these days. And I think on the fiscal side too. I mean, there's definitely been some quick or early decisions made as well as far as trying to eliminate excess in the government, and what does that mean for the economy looking out? There is possibility of some stagflationary forces as you look out. So I think the way we sort of look at things with the election is you got to have your sort of finger on the pulse of where things could be going, but no one obviously has the crystal ball. But I think it comes down to really understanding kind of the asset classes that you invest in, having expertise in those asset classes, having the right information to understand all these different managers, which you guys obviously do very well, Alok, and really know that it doesn't get any easier as you look out, but really trying to sift through all the different managers that are out there, and there are a lot of them in the alternative space, and really trying to find the best in breed, really trying to find the ones that are delivering that excess return, lower volatility, non-correlation, across private equity, credit, hedge funds, venture, real estate, et cetera. And so I think it's an interesting time. There's always opportunities in the marketplace, but as you look out, I think there's really you need to sort of do your homework and really understand how to underwrite and look at all these various managers. And there will be some of those shifts, like I mentioned, potentially, where tech and healthcare and energy, there could be some capital flows in these private markets and public markets that are going to require some extra attention to make sure you're understanding the risk and the reward in those asset classes.
Yeah, so that's going to be a lot of work, of course, for anyone involved in investing to navigate all these shifts. And from your standpoint, when you look at these family offices and you work with a lot of them, where do you think that a family office may not read the situation correctly or not have the type of resources to be able to navigate this, or just in general, what are the issues that you see family office runs into when investing in the alternative asset universe?
Look, it's a great question. Just a little bit more background on kind of what New Republic Partners does and who we are. I mean, we are a true multifamily office, but we believe in really sort of institutional caliber investment strategies across the alternative space. And so, we think like a family office. We are a family office. And so, as we think about these strategies, and really my role is sitting on the investment team and really sort of trying to be helpful and really work with other outside family offices to become experts in various parts of the alternative space, whether it be the private equity, credit, venture, secondary markets, hedge funds, et cetera. And so, as I talk to folks, and I've been doing this for a couple of years now, and really sort of digging deep into where there's sort of kind of roadblocks, if you will, and obstacles as far as trying to build out what we call sort of the endowment model, which is roughly 30 to 40% of QP eligible assets should be looking to be deployed into the alternative space, because the data and history shows that if you've invested in the alternatives world and the right managers and the right strategies, then you've been able to really sort of dampen your volatility, really generate that excess return that clients ultimately want. And so, I think one of the things that family offices, some family offices struggle with, and I see this, is if they are not, a very large family office where they can deploy resources into hiring teams, finding domain expertise in certain areas. Like for instance, I know there's a couple family offices that I've met and talked to over the last year or so, that they have an expertise in maybe the real estate side. They're somewhat comfortable in the hedge fund side, but they need help in the private side of things. So how do they get better and smarter at looking at and really underwriting some of these managers in private equity and private credit, and vice versa? There's some folks that really have an expertise and a understanding of the private markets, but really want to understand some different hedge fund managers. And so it's I think people really underestimate how difficult it is to build out a real sort of scalable, sophisticated endowment model sort of program in the alternative space. And so it really comes down to, do folks have the capital or the desire to bring on more people and really build out that team? Because I think one of the things that I've seen in my travels, and also kind of how we built things out in Newer Public Partners, is it really takes an expertise and a team. You got to have folks that have frontlines experience. You got to have folks that have really sort of been in the investing side of things and understand, okay, they've made some mistakes along the way. They know what to look for and really sort of sift through things. And so I think family offices, they start off investing in some managers, but when they start to really try and scale and go from, call it five, six, seven different individual managers to call it more, are they increasing their risk, not only the investing side, but also on the operational side? And so it's really trying to figure out how to package things together if they are really trying to broaden out and go across those different asset classes. And it can be overwhelming. And I think people sometimes kind of get to a point where they kind of freeze and they don't want to make mistakes. And that's where we try to come in and be helpful and really kind of work with them and really be looked at as sort of true partners and extension of their investment team and really try and help them, solve for what they're trying to solve for. And I think it's definitely something that is easier said than done. I think when it comes to the alternative space, and also just knowing how to categorize all these different managers and knowing okay, as they have all these different calls, how do they log that? How do they look at it? And so I think that's where I know you guys can be very helpful as well.
Yeah. So when you say overwhelming for a family office, and you're talking about across all these asset classes, various funds, and there are a lot of them, and the large, the well known versus the smaller ones that may be difficult to find or get information on. So, I'm assuming you're referring to their ability to be able to navigate the entire universe, process all the information, and then make the right decisions. Is that what you mean?
That's exactly right. There's three things that I think need to be done well and executed upon in order to really be successful or increase your probability of success in the alternative space. And number one is access. And the way we look at access is really trying to find those middle market, lower middle market managers that are not necessarily managers you read about or hear about from the big platforms out there or some of the big banks. But those are the managers where you can really find some fantastic returns. And I think in order to do that, it goes back to kind of taking that team and approach and having the expertise and really the network to be able to access those managers. And I think that's something that's super important. Number two, okay, you find those managers, that's great. So how do you assess, the risk reward of those managers? And we believe in sort of the traditional drawdown structure, not interval funds, not evergreen funds on the private side. And so, okay, so how do you underwrite those managers? And so that goes back to the team, the experience, the front lines, understanding that there's the quantitative side where, yes, obviously you want good returns, but there's also the qualitative side of the pedigree, the reputation, their background, how are their firms built, and really trying to understand kind of what makes them tick and their firms. And I think people struggle with that too, right? So it goes back to having some expertise in those various areas. And number three, look, which is really something that I think is integral into having this scale happen in this kind of smaller family office space or even larger family office space, and also RIAs that can be somewhat looked at as a family office. Depending upon their kind of their client makeup, but is really the operational side. I think when you say operational side, okay, what does that mean, right? Is on one hand, it is okay if I've got all these different managers, how do I understand, what my sizing is if all of a sudden volatility picks up in the public markets and you look at a year like 2022 when stocks and bonds went down a lot, private markets, they get marked, once a quarter, and sometimes they don't have to mark things down over, like a 3 to 6 month time frame. So, like in a year like 2022, the mark to market on the public side went way down, so your position sizing went way up in private markets. And so, how do you build the models to understand, kind of going into these investments, what the sizing should be, and sort of making sure that if you have an environment like that where volatility in public markets goes up, that you're not all of a sudden kind of over your skis and too big in certain private investments, if that makes sense. And I think number two is just trying to, I call it the plumbing of the alternative space. That there's some folks out there that are trying to solve for that. I think there's a lot of different platforms out there. Some are being matchmakers, some are kind of trying to find some one-off type investments. But I think one of the key things that we focused on that I think about a lot is really the plumbing side of things. Is how do you make it more streamlined, more efficient for family offices, RIAs, and even sponsors to handle capital calls, handle subscriptions, distributions, really get their clients onboarded, and I think that is an area that continues to evolve, and I think it will continue to evolve, and I think it's something that people really underestimate the operational horsepower it takes to really build out a real alternatives program. So I'd say those three things are super important: the access, the underwriting due diligence, and the operational side. And I think more technologies and sort of platforms that are out there that are more kind of sophisticated and more of a investing mindset and not just kind of trying to be sort of a just a tech GUI, right? And I think once again, I think what you guys are doing is great to really sort of help in that ecosystem.
Yeah, thanks. And also, I know you talked about this alternatives 2.0, the approach that you've taken. And if I understand correctly, when you talk about alternatives 2.0, you're saying that better intelligence coupled with a lot of effort that you put in the market gives you a better sense of how to spot the winners. Is that what you mean by alternative 2.0, or is it broader than that?
Yeah, no, I think that's generally right. I think one of the things that if you look at sort of the big institutions out there, call it pension funds, call it endowments, call it large family offices, sovereign wealth funds. I mean, a lot of them have gotten to that point of call it that 35-40% into the to the alternative space, and so call it this wealth channel, of which smaller family offices and a lot of family offices are part of that kind of wealth channel. Is the numbers are kind of they're kind of a little bit all over the place, but call it sort of 3 to 6% that are sort of penetrated in alternatives. And how does that get up to that roughly kind of 35-40% of the true kind of endowment model? And who knows if it's actually going to eventually get there, but there definitely is a trend going that way. And I think as it goes that way, what has happened, and which I call the alternatives 1.0, is that the big banks out there, there's a couple large tech platforms out there that have become a little bit of the matchmaker and a little bit of helping on the education side, which I think is great as far as just kind of scratching the surface on the alternative side of things. Is trying to get folks comfortable and understanding these different strategies, different managers, different return streams. But what has happened with those is you're kind of going into a lot of these really big managers, which once again is and not a bad thing. But I think, and I've seen this just from my own personal experience, working, at a firm that was small and got much larger. There is it becomes increasingly difficult to generate really good returns as firms get really big, and it's just the data shows that. And so, and so, in order to really get those returns, you kind of need to go down market and going back to those kind of middle market, little lower middle market areas. And there is more dispersion there, which means there's better reward, but there's also risk. So that goes back to like really having that sort of team and expertise in order to sort of sift through it. And so to answer your question, 1.0 is good, but in order for 2.0 to happen, which I think is more, and we think this is more into those sort of really areas that are tougher to access, tougher to due diligence, and requires that team, is how does that actually happen? And so I think really sort of understanding that it takes like an alternatives picking expertise in order to do that, and so it requires just a lot of conversations, a lot of calls, looking at a lot of different managers, and really sort of having a good sense of the opportunity set out there. And I think one of the things that we think about a lot is really with y'all's help is really trying to build out this kind of more sophisticated ecosystem in the alternative space to allow that 2.0 to happen. And so that is, creating a bit of a network effect, a little bit of we're all trying to help each other out, all trying to learn from each other. And I think, some family offices trying to kind of keep things close to the vest and say, okay, I got it all figured out, but no one has it all figured out. And so I think we're really trying to be helpful, and just as much as we're trying to sort of find folks that see interest in what we're doing. We're also trying to partner up with folks that we think can help us, and we can all help each other. And so I think it really comes down to, like, there the sponsors, there's family offices, there's RIAs, there's vendors like you all. If we can all kind of be helpful to each other and kind of create this sort of flywheel effect, that'll really allow that sort of alternatives 2.0 to really sort of take off, and allow everyone to find really good investments and really good managers. And we believe in the co-investing side and direct side as well. So it all kind of comes into the same sort of ecosystem of at the end of the day is trying to deliver the best possible outcome for the end client, whether that's the end client at the family office, the end client at the RIA, or the individual. But that's really the goal here. And I think some of the big managers out there are kind of giving you really just index like returns in those asset classes, which is, once again, it's not a bad thing. But I think if you're going to tie up capital in traditional drawdown structures or any sort of direct and co-investments, you should be demanding excess return. And the reason why a lot of these big endowments and pension funds and sovereign wealth funds, et cetera, have migrated into that world over the last 10, 20, 30, 40 years is they are kind of solving for the diversification, non-correlation, excess return, lower volatility. And that's ultimately what should happen for individuals, investors, and family offices. And so there's a lot of work that still needs to be done, but I think that's really alternative 2.0.
So that's very interesting. And you mentioned a couple of things around the partnerships that you create to make that happen. And part of it is vendors. And the way I look at it is from our own perspective, because, as you know, we offer this CRM platform with intelligence to also alternative asset managers. And before that, these CRM platforms were more focused on making firms efficient. And I always realize that that's not enough, because in your business or in the investing business, people are looking for efficiency, yes, but more importantly, I didn't see efficiency as their number one priority. The number one priority is something else. And so our focus has shifted to how we can add more value. And that's really what comes down to. And that comes through like a closer partnership, as we've done with you. Um, Also wanted to shift focus a little bit to going back to the election topic. I know you talked about the changes, and given your expertise across asset classes, do you see in the new with the new government coming in place, do you see certain asset classes, or within those asset classes, certain types of vehicles getting more attention?
Yeah, I mean, I think, look, there's always going to be opportunities in private markets. There's always going to be opportunities, with hedge fund managers too. And I think, one of the things, not only from kind of industry, economic, shifts that I mentioned, kind of energy and potentially healthcare, et cetera, but I do think there is, really an opportunity for the managers that really know how to, kind of build out, the right sort of platform of finding, nichier type stuff, right? And going back to the kind of size dynamic, I think the bigger managers are like, and they have struggled a bit, right? And I think it's, they may continue to sort of, have a little bit of a tougher time because they've got so much capital to deploy, but there may not just be that many opportunities. And that's why we go back to kind of focusing on the middle market, lower middle market areas, because, there's always going to be an appetite from these big sort of PE sponsors, private credit sponsors to be involved and get involved in either, buying some assets from these smaller managers, or potentially having sort of partnerships, et cetera, whether that's a co-investment, et cetera. So I think the focus definitely should continue to be on those kind of nichier type managers that can really navigate in this sort of newer environments. And but also I think on the hedge fund side of things too, and I know you and I have sort of talked about this a bit. I mean, there's a bit of a with this kind of cost of capital and interest rates out there. I personally come from the hedge fund industry, and I think that they're some of the best and brightest folks in the world, and really good people. And I think the most of the hedge fund assets have kind of gone to some of these big platforms out there. And I think there's going to be a little bit of a shift, and we're starting to see that in some of the stuff that we do into some more managers that understand how to short stocks, have a little more duration in what they're doing. They're a little more broadening out. Maybe some are in the small cap, mid cap type space, and so I think people really need to understand that from 1982 up until a couple of years ago, as interest rates went straight down. They've gone up, and I know they've kind of come down a bit and gone back up again. But if this kind of sort of lower bound or whatever is kind of shifted up, what does that do to private equity credit, hedge funds, et cetera? And so I think, once again, not only in the private side, but in the public hedge fund manager side, folks that are a little more niche, a little more nimble, a little more can go down market a bit, are going to have the potential opportunity set in their favor as well. If that answers your question.
Okay. And from a family, and of course, I don't know, I don't have that experience of what a family office would have to go through, when they're doing that investing. But if they have to think about, for instance, outsourcing, this process and having somebody else run their portfolio, manage it, um, is it more about the fact that they do not have the ability to create it, and there's a lot of work in creating and then scaling it, or is there some other benefit where you can provide better returns to them as well? So from that standpoint, does it look attractive as well?
Yeah, I think one of the things that I see a lot, right, is to that exact point is, a family office, maybe getting involved in private credit. And to kind of answer a little bit more of your question from before, too, it's like some of the opportunities. I mean, private credit is clearly a huge opportunity, will continue to be a huge opportunity. Secondary markets definitely have been an opportunity. VC in some of those areas that have been really kind of, painful areas to be, should start to see some uptick now that you have clarity on kind of the election side of things. So I think there's secondary market investing, private credit, some venture, definitely the lower middle market kind of PE side of things. There will continue to be opportunities, but so I think on your question, and so we have a family office that really wants to get more involved in private credit. So how do they take that and just say, just using rough percentages, they want to take that from kind of, 2% to call it 8% of their portfolio, with the goal to be collectively in alternatives up towards that kind of 30, 35, 40% endowment model. And if they don't have the expertise, right, they don't want to make mistakes. And so if they don't want to go hire people, they don't have the experience or domain expertise. They may have some folks they know and trust and like that sort of recommend different private credit managers. But how do they really take that from that kind of 2 to 3 to 8% in a scalable fashion where they're you know really mitigating risk as best they can, but still get that return that is very compelling in the private credit space. And so, especially as banks have pulled back and will continue to sort of, kind of be out of the market, somewhat, that really creates that opportunity for private credit managers. And so the way we look at it, and the way where I'm focused is really, being looked at as an outsourced CIO in alternatives, where we really are an extension of our team. We can kind of help them get comfortable and underwrite some of these different opportunities, but really, most importantly, be seen as kind of a core sleep at night allocation into kind of what we're doing, and really why we're doing it. And going back to kind of at the beginning, I mean, we are a family office, and so sort of aligning yourself with the family office where we're kind of all in this together and really sort of, creating these, call it, mini partnerships. I think people really sort of see the value in that. And so, we're really trying to be helpful. We're really trying to educate. We're really trying to sort of serve and be sort of a long-term partner with these folks, because going back to, we believe in the drawdown nature of private equity and credit, and it's a 7 to 10 year time frame in private equity for the most part, and private credit is a little bit shorter, call it 5 to 7. But and so, really trying to be helpful in understanding how to underwrite certain asset classes, really work with them to be an extension of their team. And look, and I know this from my travels too, and just a belief is, look, some folks want to find those managers themselves. Some of them want to do some kind of direct, investments into some operating businesses, and that's great. But it's really hard to take it from A to B to C to D, to go from that 3 to 8 to 15-20% across alternative asset classes if you don't build out a team. And so that is really where it comes down to, okay, they don't want to build a team, they don't want to go hire a bunch of people. They really kind of connect with us, we collaborate, we share ideas, and we really become kind of true partners, where they're doing some direct stuff on their own, some stuff they're finding, but really sort of look at our strategies as a kind of core sleep at night type allocation and alternatives, where it's we're really sort of in this together and being helpful together. And I think one of the struggles on Wall Street, not struggle, but just on Wall Street, what happens a lot of times, unfortunately, is folks are selling you something over here, and then the investing side is over here. There's not a lot of connectivity to it. And our belief, we all come from that investing mindset. We are investors first. And so and we're not selling anything to anyone, right? We're really just kind of opening up what we're doing to the folks that kind of see the value in what we're doing. And so it really is trying to make sure we both understand each other, that we're trying to put up really good performance, but also qualitatively do it with the right people and in the right way. And not only in the managers and the opportunities we invest in, but also the folks that we kind of partner in from the outside, which is really those kind of family offices that you mentioned.
Yeah, very helpful, Mark. Always insightful. I always learn a lot from talking to you. And as I said, as we approach the market from our standpoint, I would look to a closer partnership. And by the way, you mentioned travels, and so if you're in New York, would love to get a coffee or a drink, whatever works out. We are downtown. You see the S&P building behind me here, so easy. So and thanks again for joining today and taking the time.
Well, that's great. Look, I love New York. I worked in New York for close to 25 years. So I know that
Oh,
building
really?
well, and I'm up there, a decent amount still, even though I live down in the Carolinas. But I'll definitely take you up on that offer, and I really appreciate the time. This was very helpful, I think, for both sides, and always great to chat with you as well. So thanks for having me.
Thank you.